Hello Sector Watchers, welcome to the show. This is the 195th episode of Sector Spotlight for Monday the 30th of October. My name is Julius de Kempenaar and I am presenting to you from Amsterdam in the Netherlands. If you want to reach out to me, please feel free to use any of the handles on the screen. Also, if you have reached out to me in the past and you didn't get any response, then unfortunately something went wrong and your message has slipped through the cracks. I do apologize for that. If you feel I still owe you an answer, just don't hesitate and just send me a little nudge or resend your message and I'll try to get to you as soon as possible. Also, what I found out is that YouTube only sends out so many reminders or so many new video announcements a day. However, if you want to be kept on top of new videos and new RRG blog articles, you can go to the RRG blog on the website and subscribe to follow this blog and you will get a notification whenever a new article has been posted. But because we also put a little article with a summary and a link to the video, you will also get notified when a new video has been uploaded. Anyway, let's get that out of the way. It's the end of the month, and that means that this week we're going to do actually two versions of Sector Spotlight. Today I'm going to talk about seasonality, and tomorrow or Wednesday I'll do a show on the monthly charts, the completed monthly charts. And that'll be 2 months because I missed the previous one. Without further ado, let's get into it. Ladies and gentlemen, this is Sector Spotlight. As I said, it's time for seasonality, and I'm going to try to put my spreadsheet and the graphs that I want to talk about on one screen. It's a little bit of an experiment, but I think this should be readable enough. We'll only find out after the show, and you can tell me whether you could read it and whether you found that a good setup or not in the comments, or message me directly, no problem at all. First of all, let's start to look at the seasonality of the S&P 500 itself. And the best way to do that is use the seasonality tool on stock charts on the stock charts website. So here's seasonality, and you can just, I use SPY, so I'll type in SPY, and here you go. So here's SPY. I usually bring it up to the maximum of 20 years. And there's one more thing that I do, because if you look at the dates here across the top, you see it's 2004 to 2023, and that means that stock charts now, so the data has now been updated up to, October hasn't finished yet, but up to September. And I don't think that's fair because I want to use year by year. So I drag this slider one notch back and then it'll be 2003 to 2022. It's exactly 20 years. And that will give me this outlook, and you will see that these numbers across the top here are matching my numbers right here. So 45, 60, 70, that's that. And then right now we're in the period 65, 80, 70. So 65, 80, 70. That's what you're looking at. And the performance numbers here, those little numbers inside the bars, they are right here. So now you have matching bars that are matching my spreadsheet. If we look at the S&P 500, you can see that, you know, sell in May and go away, but remember to come back in September is still very valid. It's from a seasonal point of view, not necessarily from a price perspective. Seasonality is indicating that November is one of the best months of the year. 80% of the time, SPY closed higher than it opened, together with April. Those are the best months, and then you have May and July, and then December is a very good second. When we look at the performance numbers, then that is equally good. So the average performance over the last 20 years in November for SPY is 2.1%. That is the third highest reading in the year. April is 2.4, July is 2.3, and November is 2.1, with 80% of the time moving higher. Given the current circumstances, it might be hard to believe or to accept that that might actually be the case. So let's bring in a chart of SPY. So here's my daily chart of SPY, and you can see it's Monday, and we are starting the week with a very good week. We're almost closing, just closed for 15.59. It's actually a pretty strong start of the week. However, what I want to do is take a look and calculate if indeed it's a good month and we will get a rising S&P 500 or a rising SPY, and it rises by 2.1%. Where would that bring us? If we start, just let's do a little assumption that this is the close of the month. I know there's still one more day to go, but assuming that 415.59 is the close of the month and adding 2.1% will give us a little over 424 as the price target for SPY, assuming that our seasonality projection, our seasonal projection is correct. That would bring us on the chart somewhere right here for 424, 425, right here. Inside this lower series of lower highs and lower lows, that is perfectly normal. That would not change anything. As a matter of fact, it looks as if we're getting a little bit of a positive divergence here. We have touched the kind of initial target from this head and shoulders pattern. So a little bounce going into the month of November would fit the seasonal pattern, and it would also be completely normal looking at the target area that we've reached after completing this head and shoulders peak. So I'm actually not too negative for the month of November going in there. Is it the end? Is it the final turnaround for the market to move much higher and challenge new all-time highs? I think it's too early to tell. I don't know, because we still have this series of lower highs and lower lows. But within this series, and after the decline that we saw from 435 to below 410, it would be a perfect retracement, a perfect bounce back that would completely be, within the boundaries of that trend channel, fitting the targeting of the head and shoulders pattern and fitting the narrative or the expectation based on the seasonals. Now let's move on to the various sectors, and someone, I think I announced it last month already, but someone asked me, why are you're always breaking down the sectors into offensive, defensive and sensitive, and why are you not doing that when you do the seasonality? And it actually makes total sense. So I continue to do that because I think it's a very good way of breaking down the universe, and it makes absolute sense to also do that for your seasonals. So when we look at the seasonality, and as said, the expectation for SPY is pretty strong, but let's take a look at what's happening in the various sectors. And if you look at, if there's one takeaway, if you go to the various groups, and if there's one major takeaway, then it is that the defensive sectors, from a seasonal perspective, are actually pretty weak. They're like 35%, 45, 45. These are low numbers in terms of that they have been outperforming the S&P 500. That means that, just to remind you, this means 35% outperformance means that 65% of the time utilities are underperforming the S&P 500, and it's 55 for staples and 55 for healthcare. And the resulting numbers, the average numbers, are actually not too strong either. 0.1% for healthcare is the exception. The other two sectors are, in general terms, underperforming the S&P 500 in the month of November. That's the only group that has a similar move. If you look at offense, there is a very strong expectation for materials, but there is a very weak expectation for real estate. And if you go to the group of sensitives, there is a very, not exactly weak. So there's a weak expectation for energy, but the number is positive. And there is a 50-50, 47. But this is a very low expected return for the communication services sector. And then we have technology, which is 60% of the time outperforming the S&P 500, but the average performance is 10 bips below the S&P 500. However, look at industrials. 90% of the time, this sector is outperforming the S&P 500, and the average performance is 1.3%. So again, looking at at group level, then defense is expected to underperform. I should point here. But in offense, there's a pretty big spread. 70% upside for materials, but only 70% downside for real estate. And we've got 65% of the time an underperformance for energy, and 90% of the time an outperformance for industrials. That's what we have to deal with. So what I want to do is, as usual, go over the RRG and the current rotations for these various sectors and see if we can find tails that are matching or could match the numbers that we're seeing in the spreadsheet here. So here's the group of offensive sectors. And if you look at the RRG, then I think the main takeaway here is that they are all rotating lower. Materials is kind of moving to the right, but it's only starting. The other three are definitely moving into negative territory. So let's start with the materials sector. That's the one that is expected to be good. 70% of the time, materials are outperforming the S&P 500, and the average performance is 1.1%. So the fact that it is turning to the right here and starting to move in a good direction, let's quick sneak peek into the daily. So we got a little bit more granularity and find materials. You can see why that is. So it looks as if materials is actually starting to pick up, and also look at the velocity here, at the distance between the nodes. It's increasing. That indicates that there is a bit of power behind the move and that it's accelerating. We're looking at seasonality, so that's a little longer term analysis, so I switched to the weekly, but the fact that materials have started to move to the right while still inside improving is underscoring is good for this tail, and it confirms and supports the seasonal view for the materials sector. So I'm gonna say that this materials rotation is in line with the seasonal pattern for the materials sector. If we look at financials, that is a 50-50 tail, so we can't say much about that. It's very close to the center of the chart. But the one that really stands out here is real estate. 70% of the time, the real estate sector is underperforming the S&P 500, and the average underperformance for the real estate sector is minus 1.4%. And look at this tail. This tail is screaming underperformance. It's just rotated through improving and is now moving back into lagging. It's the worst sector of this group, and it's completely underscoring what we see or what we can expect based on the seasonals. So the real estate sector is very likely going to underperform the S&P 500 and show a negative return compared to the S&P 500. Now, one thing that you need to be aware of is that an underperformance of 1.4% for the real estate sector still means that it could show a positive return in the month of November of 2.1 minus 1.4, so that's 0.6, 0.7%. So even if it's up 70 basis points, it's still underperforming 1.4% based on the averages. That's the one that you need to be aware of. But real estate very likely going to be an underperformer in the month of November. And then we've got consumer discretionary. The odds are not fantastic. The average return is not fantastic. The tail, however, is actually not looking too great. So inside offensive, a good expectation for materials and a very weak expectation for the real estate sector. If we go to defense, then we already saw that as a group, they are very likely to underperform the S&P 500, and the performance figures are not too great. If you look at the tails, then you can see that staples and utilities have started to pick up on this weekly RRG, but they're still relatively low on the RS ratio scale, which means that they're still in relative downtrends. The healthcare sector has turned around. It has inside improving, has started to move lower and head back towards the lagging quadrant. That's quite a negative rotation. Now, when I look at the numbers here, I don't think there is a lot of confirmation, so to say, because the ones that are, so utilities is the weakest one, it's the weakest reading. 65% of the time the sector is underperforming the S&P 500 with the largest average underperformance. But if you look at the tail, it's actually going into the right direction. So from that point of view, utilities is not confirming, the actual rotation of utilities is not confirming the seasonal expectation. And the same goes for the consumer staples sector. The current tail, the current rotation of the staples sector is not confirming, well, you know, staples is kind of in the middle, but the expected return is negative. And if you look at healthcare, then it's also sort of in the middle. It's a coin flip. 45 is, for me, is the same as 50%. So I'm not going to make any calls, I'm not going to make any expectations on those sectors. As a group, I do think they're underperforming. The performance is negative, and it would kind of underscore, because with 80% of the time SPY leading, that would absolutely be supported by weak defensive sectors, because as we know, when defensive sectors are underperforming, it's usually a good thing for the market. And remember the chart that we looked at the start of the show with the S&P 500 still in that series of lower highs and lower lows. Within that rhythm, even a rise of 2.1, maybe a little bit more rise, it will still remain in that series of lower highs and lower lows, and that would completely fit with the defensive sectors underperforming in the month of November and SPY jumping while still remaining in that rhythm of lower highs and lower lows. And then we have the group of sensitive sectors. That's a mixed group anyway, and the seasonal pattern completely acknowledges that, so to say. If you look at the various tails here, so here we have communication services, 47%. It's as I said, the flip of a coin. It doesn't make a lot of sense. We cannot count on this seasonal expectation. The tail is actually looking pretty strong, but it has nothing to do with how it looks from a seasonal perspective. If we look at the energy sector, then we see this very long tail that's rotating through leading and now losing relative momentum while still gaining slightly on the RS ratio scale. But from a seasonal perspective, 65% of the time the energy sector is underperforming SPY in the month of November. However, the curious thing is that the average return is 0.2%. And that means that when the energy sector is outperforming the S&P 500, it's doing that very, very strongly. The question is whether we are in a strong period for the energy sector or in a weak period. And I am tempted to say that we're going into a weaker period for the energy sector. Remind you, we're looking at monthly data for the seasonals, and this is a weekly RRG. So we need to kind of, in our head, move forward 4 nodes here. So maybe like 1, 2, 3, 4. I can totally see this rotation moving 4 weeks ahead and still going a little lower and a little higher, a little lower on the momentum scale and a little higher on the RS ratio scale, and hit the weakening quadrant. That would be completely normal in this type of longer term rotation, and it would fit the seasonal expectation of the energy sector underperforming the S&P 500. However, it's very unlikely that it's going to be with a massive number, with a big number. So probably not the best of tradable opportunities, if you wish. If we move to the technology sector, and that's right here, it's inside weakening, but it's started to pick up and it's moving towards the leading quadrant. And if we look at the seasonal expectations, 60% of the time technology is outperforming the S&P 500. Not massive, not very, very significant in my eyes. I usually don't spend a lot of time on sectors with only 60% of the time outperformance. Especially not when you look at the average return, that's minus 0.1. That means that when technology is underperforming the S&P 500 in November, it's doing that by a big amount because it's pushing that average number to below 0. And that makes it a little doubtful whether this rally is really going to push XLK above the S&P 500 in the month of November. So I'm going to stay kind of neutral on the technology sector. Of course, with the expectation for a SPY being, very positive, you can expect, and it's probably needed, that the technology sector at least shouldn't decline very much. I think that's probably the best way of saying it, the best assessment. Now, the cracker of this month, the cracker of this seasonal month of November is for the industrial sector. 90% of the time, the industrial sector is outperforming the S&P 500 or SPY. And the average outperformance is 1.3%. Now, that is a tradable opportunity. That is a number that you want to see when you are putting seasonals in your workflow. The only thing is, look at the rotation. It's going the other way around. And that is quite disappointing. So no matter how strong the seasonal expectation is, the current rotation is totally not supporting this strong seasonal expectation. And to be honest, let's have a little sneak peek on the daily. So here it's also inside the lagging quadrant, and it's going to be very difficult. We do need a very rapid turnaround on at least on the daily, and then maybe also on the weekly, but it's going to be very, very tough for the industrial sector to follow this strong seasonal pattern. So I'm no matter how strong it is, no matter how strong that expectation is, given the current rotation, I'm going to put a big question mark on whether that's going to be achievable in the month of November for the industrial sector. We talked about all of them. Let's have a quick look at a few of the major calls, the major odds that we have seen in this table, and look at a few of the individual charts. Let's start with the materials sector. Just to remind you, 70% of the time outperformance, average performance 1.1%. We already saw that it's kind of okay on the RRG, on the relative rotation graph. It's right here, it's starting to move to the right. So this sector is confirming or starting to confirm the rotation that's visible on the RRG with the seasonal pattern. And here is the price chart. And you can see how it has last week touched the lower boundary, that support level that's around 74. And you can see how the RRG lines are gradually moving higher, and the green line here, and that's that little move that you see on the RRG starting to move to the right and up, seems to be bottoming above the 100 line, and that's pushing it further into that improving quadrant, indicating a potentially strong month for materials ahead, especially when 74 holds. We can see a move up in price. It could go to, let me put my cursor here, this would be somewhere like 76.70, or where the previous high and lower aligning, that's 79.5. Quite a decent upside for the materials sector, which would align with the seasonal expectations and the emerging rotation as we've seen it. We go to real estate, that's the one right here. 70% of the time underperformance, and the average performance minus 1.4. This is one of the stronger alignments this month. This trend is speaking volumes. We just broke a major support level. The RS line, the raw RS line, is still moving lower, and the RS ratio line is at a very low level, and the RS momentum line has just crossed back below 100, pushing the tail back into the lagging quadrant. This is one of the stronger signals from an RRG point of view, from a price point of view, and from a seasonal point of view. So probably seasonals are aligning with RRG, is aligning with the price chart. Probably ain't got much better than this. Then we have utilities. I chucked it in. Probably not the best to look at. 65% of the time underperformance, average performance minus 1.4. We just broke support. We're kind of testing it. I can see another decline here, but the momentum is picking up. It's kind of difficult to call here, but if gun to my head, it's probably going to be an underperformer because this trend is still lower. Price is running into resistance. So eventually, in the next couple of days, maybe weeks, I believe that this will turn around and the RS momentum line will drop back below 100, pushing utilities back down into that lagging quadrant. But that's just a little, I don't know, eyeballing outlook. It's not massive, and it's certainly not as strong as the call for the real estate sector and to a lesser degree the materials sector. We move to energy, then here we see 65% of the time underperformance. The performance number itself is not great, but when I look at the price chart here, we've tested resistance, we failed, and we're now resting at support. And that's usually a difficult call because it can go two ways. We can just support holds and we bounce up and we go back to testing the resistance, or we break and we get an acceleration lower. If I look at the relative strength here, I'm inclined to think the latter, because relative strength is rolling over. We're losing relative strength. This little up move seems to be losing pace. And when we break support here, that's very likely going to accelerate the weakness in relative strength. So maybe not at the moment, but keep an eye on it. When you see energy breaking this support level right here, which is right 84, so if XLE trades below 84, sustainable, that will very likely push RS lower, and it will bring back the alignment with the seasonal expectation, but only when you break this support level. If we hold it and we move up, this makes no sense. If we break 84, then this kicks in, the seasonal weakness kicks in, and we will very likely see a little bit of a decline in energy, at least underperforming the S&P 500. And then here is the industrial sector. As I said, 90% of the time outperformance, 1.3 average performance. But if you look at the tail on the RRG, so here is pushing rapidly into the lagging quadrant, and that is totally not aligning with what we're seeing here. When I look at the price chart, we're resting at support. So again, here is a slight possibility, and you see the same with the RS line. It's resting at support. The RRG lines are picking up that renewed decline. It started declining right here. This is when you saw the RS ratio moving lower. Again, when this holds, you can see a little bump higher and potentially XLI outperforming the S&P 500. And when I do a little calculation exercise, just as what I did with SPY, if we're going to assume that 97.64 is the end of the month, is the last close of the month, and we add 2.1 plus 1.3, because these numbers are outperformance numbers, so the expected price based on seasonals for industrials would be 97.64 times 1.034. That's 2.1 plus 1.3. That's 3.4%. So 1.034, and that gives us 100 and almost 101. And that would be this area here where we had this little bump. I didn't put in this spike low because the close is right here on top of my cursor. So, you know, even if we get that bump, it would totally be in the rhythm of lower highs and lower lows, just like the S&P 500. So that could definitely be the alignment. Is it worth a shot? Probably, but what I would love to see is at least an improvement on the shorter term picture, on the daily picture, some sort of a bottom being put into place out of which XLI can rally. Right now, it is totally conflicting with the current rotation, and the price chart is not sending us any positive signals as of yet. So wrapping all of this up, out of these total numbers and seasonal expectations, S&P very likely to move higher. There is a good case to be made for that, even within the series of lower highs and lower lows. Materials, probably the best. You know, it's lining up, the chart is aligning, the rotation is aligning, the seasonal expectation is good. And the best tradable opportunity, if you ask me right now, would be a negative expectation for the real estate sector. 70% of the time it's underperforming. The average underperformance, 1.4%. That would send XLRE much lower. So if you I've told this many times to people, we're always focusing on where we should be invested, but it's probably even more, or at least equally important, to know where we should not be invested. And in this case, where we should definitely not be invested is the real estate sector. So if you're in the game of outperforming the S&P 500, you could probably achieve it in the month of November by buying the S&P 500 and eliminating the real estate exposure. By just eliminating the real estate exposure, you would probably already give you a little heads up, ahead of the performance of the S&P 500. Anyway, SPY really positive, materials positive, real estate negative, energy only when it holds up above that support level. When it breaks, we will get in line with the negative rotation as seen from the seasonal expectation, and the industrial sector needs to put in a low and start moving higher in order to get in line. These are maybe happening, they're not happening yet. Materials and real estate are happening right now. And that wraps up the first part of Sector Spotlight for this week, all about seasonality. Please remember, Sector Spotlight is available on demand on the StockCharts YouTube channel, usually recorded and uploaded on Mondays. Feel free to share your thoughts and ideas in the comments below the video. You can see the handles on the screen. I'm looking forward to seeing you again at a new episode of Sector Spotlight later this week.